Good morning and welcome, Patriot Radio News Hour. I'm Joe Jaquint, CEO of the Patriot Trading Group, and our toll-free number, 800-951-0592. The website at allamericangold.com, and a happy Easter to everybody. Good Friday. We are closed tomorrow. Both Arizona and Colorado offices will be closed tomorrow for Good Friday. The markets are closed. We'll be back on Monday. But don't worry, you can always go out to allamericangold.com, go out to the shopping cart, and buy all the gold and silver you like 24 hours a day, 7 days a week. Rain or shine, good weather, bad weather. It doesn't matter. It will be there for you. As we're wrapping up, we got more economic data out today we got to go over. We had retail sales. We had import price inflation data out, jobless claim data out. We'll get to all of that and a whole bunch of other stuff, more Freedom of Information Act requests to find out what and who the central bank's been loaning money to. This is something, if you have money market accounts, you want to pay attention today. Those were in a lot of trouble when COVID started to run through the shutdown and who was bailing out who. And remember, yesterday we told you, listen, there's more than one set of rules. You have I'll call them, rules of convenience. Rules that really aren't rules. Growing up, we all did it where you're playing a game. Maybe you're playing with your brothers. Maybe you're playing it with the neighbors or the kid across the street, and all of a sudden you're winning the game, and lo and behold, the rules change. This is exactly how they have all of the things they tell you to do. This, the pinstripe bandits, all the places where they want you to keep your money. Just understand that whenever they decide, they can change the rules. Right? We saw it most recently in the nickel market. Matter of fact, there's a lot of people saying that in Chicago, where all the commodities in the United States trade in Chicago, in the mercantile exchange, saying, hey, we should try to make a play for the London markets because, China owns London. They actually own the London Metals Exchange. Well, guess what? It's not happening because I think most people know, we would have done the same thing. Right? Emergency, let's change the rules. What you need to know, what does this mean for you? You need to know the following. Whenever they determine there's an emergency, they can stop you from taking money out of your bank accounts. They can stop you from closing your bank accounts. They can stop you in your E-Trade or Schwab or, Robin Hood, for those of you that, quote unquote, day trade at any moment. Nope, you can't. You're stuck. Whatever stocks you own, that's what you own. They can stop you from withdrawing money out of your money markets. They can stop you from making changes to your 401ks, to your IRAs. And again, when does that happen? When you absolutely, positively should make those changes. It's a crisis. You know what? Hey, I better get that money out of the bank. I better go all cash in the stock market. They're not going to allow it. And that's why you need to be prepared, because we know another crash is coming. Right? I mean, come on, you don't have to be a rocket scientist to figure it out. I mean, we got big trouble ahead, Jason, and they've got the game rigged.
Yeah, Joe, it's rigged in ways that I don't think most people really understand. You're at the top of the ladder, so to speak, and you want to do well yourself, right? You could own half of a country, but hey, there's still half a country to buy, right? So they make
right.
the system
right.
produces for them, Joe.
Yeah, and again, I called my broker, and he said, no, that isn't true. Then you need a new broker. Because one of two things. Number one, he either doesn't know, which would be shameful, or they do know, but hey, they've been told to lie. Because if you knew the truth, you would get yourself protected. I mean, it's really just that simple. So you look at numbers today, retail sales. They were up 0.5%. The problem was now this was a March number, month-over-month inflation, just month-over-month from February to March, was up 1.4% for the month. So that actually means at 0.5% in growth of retail sales, we actually shrunk by almost a whole percent. It was a big number. And of course, if you took gasoline out, retail sales had no growth at all. So Jason, again, what have we been talking about? Inflation much worse than you thought, much worse than they were telling you anyway, which is exactly what we've been saying. That's exactly what's been happening. An economy that is slowing down, which is exactly what's happening. And at the same time, they're going to start with the big rate hikes and allegedly selling off all these bonds that they purchased. You know what that's called, folks? It's called stagflation. How do you like it so far? Patriot Radio News Hour. We're going to be back right after the break. 800-951-0592, Patriot Radio News Hour. Joe Jaquint and Jason Walker on retail sales, excluding gas. Retail sales were actually down 0.3%. Again, not what you want to see. The control group. This is, and again, the Federal Reserve playing games with. This is the number that they use to calculate GDP. It's called the control group. That number was down 0.8%. At the same time, import prices. So think about the inflation data we got this week. Tuesday, we had the consumer price index, which, again, it doesn't actually track inflation, but we got to take it for what it is. 8.5%. 8.5%. And inside of that number, if you took the inflation from February to March and you annualize that number, it was almost 14%. Then yesterday, we had the producer prices. Now, what you would like to see is the producer price inflation to start falling. Because then maybe, okay, if they're paying a little less, maybe we can pay a little less. That just makes sense. It didn't happen. Matter of fact, producer price came in at over 11%. And then once again, if you took just the increase from February to March, the producer price and annualized that, it would have been 17%. Today, we got import prices, right? So this is, and obviously, as we know, right, the United States is a debtor nation. Right? We don't run trade surpluses. Matter of fact, it's not even ironic. We closed the gold window essentially, we'll call it Bretton Woods 2, if you will, in 1971. I want to say the very last trade surplus the United States had was 1972. And we've never run a trade surplus since. Import prices, Jason, up 12.5%. And once again, do your little, hey, if you just take February to March, you're talking 20% inflation if you annualize.
Joe, I'll tell you this: what you're explaining on the last segment, and then coming to this one, growth is slowing, and what I don't think, I think, Joe, you hit people sometimes. I think you're so big and you're so direct, and it's hard for some people to keep up. I'll try to dumb it down a little bit. When you drop interest rates and you sell off the balance sheet, when the Fed does that, that's normally to cool off a red hot market, and growth is slowing. Whatever they say the market is doing, which I don't think it's been red hot and the economy's been great, but by their numbers, Joe, it is slowing by their own numbers, and that's not the time that you raise interest rates and sell off balance sheet, right, Joe? That's usually where quantitative easing comes in, right?
Well, yeah, it's the opposite effect. See, we should have been, when we were having this huge growth, that's when the Fed should have been raising rates.
Yep.
Right? That's when the Fed should have been reducing its balance sheet. See, but it's in reverse. Because really, ultimately, what we had was we just had a massive increase in the money supply. That was it. Right? We handed people money. We flooded the markets. It wasn't sustainable growth. And now all of a sudden, and again, because they want to believe their own nonsense, the modern money theory, we can just, you know what? Forget about everything we learned in our textbooks at Harvard and Yale. Yeah, we can just print all we want. Because we got all these tools. See, we can print it all because we took our balance sheet from $700 billion to $9 trillion. So, see, it didn't really all get out there. It's fine. It's wonderful. Oh, that's wrong. Matter of fact, you know what we're learning today? Keynesian economics is a farce. Right? Keynesian economics came in really during the Great Depression. And you got to remember, the size of our government back then was tiny. Heck, we didn't have budget deficits. I mean, during the Great Depression, people are shocked to realize, you know what, we ran a lot of budget surpluses. And I mean, we tried to, you know what the government tried to do? Hey, we're going to spend what we take in, and maybe every, 1 year we may go a little over, but the next year we'll go a little under. I mean, you got to remember the whole debt, the entire national debt was like $100 billion in 1933. The whole debt. That was it.
Joe,
most of that was from World War I.
I think, Joe, that the decisions they made with inflation last year, not attacking it, I think it's purposeful. I think there's some sort of desired effect that they want. I mean, lo and behold, the war starts in February. In the midst of this inflation blizzard, I think there's definitely a plan in the works, Joe, for where they want to push this thing.
I'm going to tell you this right now. We said it in the Half Empty Cup of Joe show yesterday. This is a banker war. There were consequences for bringing interest rates to zero for a decade and a half. And let's face it, a lot of the world, and I'll say the 93 countries that are voting, to sanction Russia. A lot of those countries, it was negative rates. I'm going to tell you right now, we have a problem. We have a problem with our pensions. We've got a problem with our unfunded liabilities, right? We've got a problem with the size of our national debt, right? And all of these things factor in. And I think to Jason's point, we've got to have something to blame, right? It's almost like we have to have a war so we can say, see, it was Russia's fault.
Yep.
Right? It was Russia's fault. I know. Sorry, guys. All the pensions are going to get wiped out. Sorry, guys. Your stocks are going to get wiped out. Hey, sorry, guys. Your 401k is going to get wiped out. And you know what? Sorry. Hey, your bank account's going to get wiped out. But it was Russia's fault.
Joe, and check this out. 0% interest rates and big-time quantitative easing, well, that was done on the watch of a socialist president, Barack Obama. And look, and somebody tried to attack their monetary system. That was Libya, doing a gold and oil monetary system for Africa. and they shut that down in less than a year, 2012. The news had to cover it. But, boy, they got that behind them as fast as they could, Joe. But Russia, which I think is a fake threat to their banking system, I think it's orchestrated. This is the biggest emergency in all of history. Right, Joe? What's the difference? Why isn't Libya attacking their financial system the same as Russia? I think it's because Russia is playing a part. I think they need this situation for what's getting ready to happen.
Yeah, and again, if you take Crimea, the Donbass region, if you go to any map prior to the end of World War II, that was Russian territory.
Yep.
Everybody there speaks Russian. I mean, everybody. It makes no sense. Yes, I know after World War II, they drew some crazy borders. I mean, right, we're still, paying the price for some of the borders that got drawn, but it just makes no sense.
Well, Joe, and check this out. If they wanted to save a lot of people's lives in Ukraine, Zelensky could have simply just stepped aside and let Russia put their guy in. Well, nobody dies. Nobody dies.
Step aside. He could have just said, "You know what? You're right."
And he is an actor.
Right? You're right. You guys have that. We'll have ours. Everybody, everybody walk it back. But that didn't happen, and I think deliberately didn't happen. And I want to point some things out. The Federal Reserve has been doing a lot of things that they say they're not supposed to do. Once again, rules. Rules that apply in one situation but seemingly don't apply in the next. The Martins, Wall Street on parade through Freedom of Information Act request, found out that the Federal Reserve was bailing out the money market mutual fund liquidity facility. What? Yeah, who knew that? I didn't even know that existed. Right? The MMLF. The money market mutual fund liquidity facility. And this is where, remember during the financial crisis, one of the things that led to the collapse of Lehman was the money market. It broke the buck, right? Think about this. Bernie Madoff would probably still have been operating today, right? This is how corrupt Wall Street truly is. The only reason why he got caught was because everybody panicked and they started calling Madoff saying, "I want my money.
Yep.
I want to get out. I'm going to the sidelines, Bernie." That was the only reason they caught him.
Joe, and the Fed has something that Bernie Madoff didn't have. If people want to get rid of they want to get out of dollars and be done with the Federal Reserve, Ponzi scheme. When people come looking for money and they're freaked out, the Fed can just give them more. Bernie Madoff couldn't just print up a bunch of money.
Right. And my point being, guess what? They changed the rules.
They changed the rules.
So guess what? Next time we can't catch Bernie Madoff.
Nope.
Because the Fed's going to say, nope, you can't go to the sidelines. Oh, you got a money market account? Sorry, can't go to the side. It's an emergency. So in March of 2020, the Federal Reserve had to bail out the money markets again. I didn't even know the money markets were in trouble at that time. We speculated. We're like, how can this be if no one's paying rents? Right? How could this be? It was done through the Boston Federal Reserve, which is kind of interesting because you would think that would fall under the New York Federal Reserves, right? Because they're the ones that oversee Wall Street. But no, it was done through the Boston Federal Reserve. And then the Fed took some steps to hide. So journalists, there's journalists out there that actually do this type of stuff that made it almost not impossible, but extremely difficult for them to figure out what they were doing. So instead of saying, hey, this was the fund, right? So as an example, and I'll give you an example of one of the funds that got bailed out. How about here we go. One of the funds that got bailed out was from Morgan Stanley. Morgan Stanley, the Fed lent them $556 million against collateral, and instead of saying what the collateral was, they used its like barcode number. 2254EAF16. Well, guess what? That happened to be a tranche of debt from Credit Suisse that was a fund that had collapsed by 50%. Instead of saying, hey, we let Morgan Stanley borrow money from Credit Suisse and it was their commercial-backed real estate fund, nope, they've used these numbers to try to hide it. And then they wouldn't even name the bank that got the money. Yeah. See, they don't want full disclosure. They want to know everything we do, but they don't want us to know anything they do. Welcome back, Patriot Radio News Hour, and just kind of giving everybody a heads up. There is a price to pay. You know, and I remember when we were doing shows back when it was Eric and I, telling you that this dog doesn't hunt, this math doesn't work. Of course, the money markets were going under. Rates were negative. Can't work. Just can't work. And now, thanks to the Martins and Wall Street on Parade and the Freedom of Information Act request, I'm going to tell you right now, every major U.S. bank, and you know what, pretty much this is when I was going through this. I'm like, okay, well, I know the banks that are going to be left. When it's all, because remember I told you they're going to get rid of most of the banks. You know, and they talk about J.P. Morgan, Goldman Sachs, Morgan Stanley, Citi, B of A, Wells Fargo. You know the names. But here's what's really interesting. First of all, how they tried to hide it, right? They, instead of just listing the fund. Hey, it's the Credit Suisse. It's the Deutsche Bank. It's the ABN AMRO. And by the way, another thing that was really interesting in this report, almost all of these funds that they, and again, only of the ones that they reported, when you finally were able to trace it all back, because they tried to make it almost impossible to trace, you know, okay, who got bailed out and which fund and which bank originated it. But what was funny was it was almost always a European bank that was selling to U.S. banks these funds that they were using for all of you out there with your money market accounts. These things. Here's what's so funny. The Morgan Stanley one that we were talking about, the funny part was the name of that fund was the Morgan Stanley Institutional Liquidity Funds. Right? They were selling this to you and I. It's like, hey, this fund's got tons of liquidity. Don't you worry, man. You can put tons of money in. You can have it whenever you want. It's going to be great. Oh, wait, we need to bail out. And it was hilarious as we watched. It was $750 million here, $600 million here, $500 million here, $800 million here, $475 million over and over. It was, Jason, we're talking billions and billions of dollars. And when you traced it all back, it was leading up to all of these European banks. And ironically, are we shocked now with this thing that's happening over there in Ukraine and all of these things? They need cover.
Yeah, Joe, and this has been going on for a long time. I mean, we're talking about what's going on now, but this is decades and decades long in the tooth. I mean, Joe, I can't remember a decade that was a lower standard of living than the decade after it, right? It seems like ever since the 1960s,
right?
So that standard of living's been down every decade.
We keep declining. Now, legally, the Fed, by its own rules, wasn't supposed to do this. Because they know all that you're doing is making the problem worse. Hey, I'm going to kick it down the road. I'm going to cover it up. Right? Think about it. The movie Big Daddy, the kid wets the bed and they cover it up with newspaper. Well, that's all well and good until you got to go to bed the next day. And this is the same thing. So in their own statutory laws, in order for the Fed to have an emergency loan program, it requires that these emergencies be short-term in nature. Well, man, hey, Jason, they've thrown that right out the window, right? Think about it. Their balance sheet's $9 trillion. There's nothing short-term about it.
They talk about
secured with good collateral. It says it right in their bylaw. Well, obviously, if they need to be bailed out, the collateral's no good. Most of the collateral was down anywhere from 35 to 65%. Available to a broad base of financial institutions. In other words, hey, we can't just bail out our darling little banks. Well, you know what's funny? When they got roughly, let's say, just under 5,000 banks. But according to the Martins and the Freedom of Information Act, less than 100 banks got these bailouts. I wonder what that tells us.
Well, Joe,
so none of those things happened. And again, it doesn't matter. Well, it's an emergency. We're going to do what we want, right, Jason?
Yeah, and the Fed balance sheet is just, something that people need to look at. Those are mortgage-backed securities and treasuries, things that are bought with dollars, right? And Joe, I think as long as people keep accepting dollars for things, they're just going to keep blowing that up over time. They may sell it off for a little while right now, but we know they're going to have to buy more. And the thing will only explode when people figure out that this is a valueless money, and then things get really crazy. And I think that's what they're bracing for, Joe. Maybe they're waiting. It's like, maybe this is it. Maybe the jig is up this year. But if they can get away with it, Joe, they'll take that to $18 trillion. They'll take it to $40 trillion, right? They need to put the dollar somewhere, right, Joe? And if people will buy it from them, if countries will buy it, then they can reduce their balance sheet. What's happening is $9 trillion because nobody's buying it, Joe. So they're just going to keep putting it there.
And again, $9 trillion. Just give perspective how big this balance sheet is. That'd be the third largest economy in the world.
Yep.
That's how big it is.
It's the size of Japan, and it's the size
China.
It's the size of Japan.
Double the size of Japan. Japan's like $5 trillion.
It's Japan and Germany together, Joe. Japan.
Right, there you go. Thank you, Jason. Japan and Germany together. And to Jason's point, it's only getting bigger. Listen, they may pretend for a few months to sell it off. Believe me, it's going to be much, much higher. We're getting ready to come up on the break. I'll say this. The today's special, we've got some more 1/10 ounce. We went out of stock. We got some back in now. 1/10 ounce American Gold Eagles, $250 a coin on the 1/10 ounce, the golden dimes. That's saving $15 a coin, so it's a great savings. But when we get back, we are buying Silver Eagles. If you have Silver Eagles, I know right now, spot silver is $25.55. If you've got untarnished, untoned Silver Eagles, we're buying Silver Eagles today at $34 a coin.
It's a rare opportunity. Opportunity.
So if you've got some Silver Eagles and you want to get, over $9 over spot for them, call us up, 800-951-0592. We'll be back after the break. 800-951-0592. I don't know that I've ever done this, but it is what it is. There's a huge physical silver shortage. We're paying $8.50 over spot for untoned silver eagles. Now, some of them, some years the mint did a good job, some years they did a bad job. But if they're toned in black, because silver will tone. You're gonna get. We'll handle those like they're around, right? So you'll get $28 for the tone. But if they're fresh and they're white, $34 an ounce on U.S. silver eagles. So one of those green tubes would be $680 if you want to sell them back to us at 800-951-0592. I'm laughing because we sell gold and silver, but we buy it too, right, Jason?
Absolutely, Joe. And I have a little soft part in my schedule today. I usually am blasted busy, so this is something I could handle. I don't know about Joe's exact situation. I can handle quite a bit of silver today if you wanted to bring in today or make arrangements for early next week. But this can be a quick turnaround, Joe.
Yeah, absolutely could be. And if you want to trade it into 10th ounce gold eagles, we can do that as well. Again, 1/10 ounce American gold eagles at $250. I think the reason why the 10th ounce have been so popular, the last time they were this popular, Y2K. And I think because everybody knows digital money's coming, and they want to have that gold and silver to barter with, just in case that's the only way I can get 223 ammo or 556 ammo, or to get an AR or whatever it may be, right? Hey, I want some. I've got some needs for gasoline. I want to get some gasoline, and with the digital currency, I can't buy it. I need to trade for it. These items very, very popular. So once again, we are buying U.S. silver eagles at $34 as long as they're untoned. Spot right now about $25.50. We're paying $34 on the U.S. silver eagles, the 1/10 ounce American gold eagles. We are selling those for $250 at 800-951-0592. Everything's down today. And it's expiration day. The markets are closed tomorrow, so not a big surprise. Gold's off about $10 here, 1969. Silver's down about 50 cents. And the Dow was higher all day today. It's just gone negative. The S&P's been negative all day. The Nasdaq's been negative all day. The 10-year note, which over the last 3 days had been falling, which didn't really make sense, got all the way down to about 264 yesterday, all the way back 281 today. So came roaring back today. And that really makes a lot of sense. Even the Japanese 10-year is now yielding 0.25%. The Japanese 10-year note has been negative for like the last 15 years plus. Even they're in positive territory now, Jason.
That's exactly right, Joe. And I wouldn't be too surprised if gold makes a little late day rally going into this weekend. So this gold special would be quite the nice little buy if you jump in today.
Well, you think about it here, you're saving $15 on a 1/10 ounce American gold eagle. That'd be like gold falling 150.
Right.
Not 15. Right, so it's great value. And to Jason's point, wouldn't be surprised, but I think again next week, you got to remember gold was up like 6 days in a row. It can't go up every day, but take advantage of it. 800-951-0592. For those of you out there with those money market accounts, just know you are not immune. They changed the rules from the last time. And I know a lot of you out there say, well, the last time, you know what, I sold my stocks, I went to cash, I lightened up. They're going to make sure you can't do that this time. It's an emergency. And this is why I want to show you every time the SEC and the Federal Reserve break their own rules. The difference is now, because of what happened the last time, they changed the rules, so now they can do it, Jason will say, well, hey, sorry, that was the rule.
Everyone should follow the rules.
Hey, sorry, I mean, hey, we made a big announcement.
Right, Joe.
On the back of somewhere in your trading platform, your IRA, your 401k, you clicked a box or you said okay, or it was in the small print somewhere. Oh, well, we notified you. I mean, it was on page 3 of your statement when you had to turn it over and look at the back. But, you got notified. Sorry. So you're stuck.
Everybody follows the rules, right, Joe? Just follow the rules, and then right about the time you're following the rules, they change them on you.
I'm going to say this, too, that we haven't brought it up. J.P. Morgan had earnings yesterday. Wells Fargo had earnings today, and they both sucked. And you know what both banks said? And we're going to hear this from all the banks as they release earnings. Defaults are starting to happen.
Yep.
Matter of fact, J.P. Morgan, Wells Fargo both had to put more money into loan loss provisions. The companies like Morgan Stanley and Goldman, even though they're technically now banks, but they're really trading firms that they made banks, their earnings were good, which makes sense. Everybody's been freaking out about the stock market and doing a lot of trading, but the actual banks themselves, not so much. Not a good sign. Patriot Radio News Hour, final segment coming up. 800-951-0592. We are selling 1/10 ounce American Gold Eagles, $15 off, $250 a coin, $250 a coin, and it's exactly what it's exactly a 1/10 of an ounce of gold. The interesting part is if you got 10 of them, that's an ounce. It's actually buying 4 $5 liberties would cost you $140 more. So that's rarely, we're just seeing all these abnormalities in the marketplace. And Jason, you know this, when it comes to gold, 10th ounce is always the most expensive. But it's just one of those markets where, fractional gold getting harder and harder and harder to get. 1/10 ounce American Gold Eagles, $250. We are buying. We're not selling. We are buying silver eagles, untarnished silver eagles at $34 an ounce. That's $8.50 above spot, or $680 a roll at 800-951-0592. This is just breaking. This is going to be a problem. The European Commission, in an internal note, Zero Hedge, is reporting that they said that European buyers agreeing to pay for Russian gas in rubles will be a violation of sanctions that they have imposed on Russia. Now, Russia gave them a workaround and said, all you unfriendly nations, you can pay Gazprom in euros or dollars, whatever the contract was. But then Gazprom was going to immediately convert it to euros to complete the transaction. The European Commission says, nope, not going to work, not going to allow it. And again, if the gas gets shut off, I think crude oil goes up, $20, $30 a barrel instantaneously. Gold would probably go up $100 to $200 instantly. Natural gas would probably triple in price, Jason.
Just think of what kind of a bully tactic that is, Joe. If you're not with me, you're against me. That's essentially what they just said.
Well, and again, we got to remember, right, the United States has not allowed Russia to make the latest bond payment. We're in this 30-day grace period. Russia actually had the money, and they had euros or dollars Our government said no. Russia tried to pay it then in rubles. They said no. These next 2 weeks are going to be very interesting. I have a feeling if the United States forces Russia in default, then Russia's appealing to the national court or something. I don't know who. Why do I think the response from Russia will be, okay, if you're going to force us to default, we're shutting the gas off?
Just think about what you just said, Joe. Somebody that owes a debt wants to pay. They want to pay in the normal currency, and the borrower says no. How about euros? No. Well, how about rubles? No. You talk about rigged, Joe. What a rigged situation. Hey, we have debt we want to pay back. No.
And again, this is going to cause huge turmoil. I think this is why, too, remember now, and I think, what was it, Sri Lanka? We already got another country in default as well. We haven't even talked about it.
Yep.
But why do I got a feeling these banks, why they're beefing up their loan losses? Because they've been told what's coming. I hope you guys are getting ready for it. 800-951-0592.